A marketplace where fortunes appear and vanish in the blink of an eye. Where a single day can make you wealthy beyond imagination, or destroy everything you've built over a lifetime. This is the stock market. For centuries, it has been the great engine of prosperity, funding the railroads that crossed continents, the technologies that changed how we live, the innovations that shaped the modern world. But it has also been the scene of catastrophic collapses, crashes that wiped out millions of families, triggered global depressions, and exposed the darker side of human nature: greed, panic, and mob psychology. Throughout history, three questions have haunted investors. Why do these crashes happen? Are they inevitable, or can they be avoided? And how is it that during these disasters, some people don't just survive, they become extraordinarily wealthy? This is their story. Chapter 1. What is the stock market? Let's start at the beginning. The stock market is simply a place where ownership in companies is bought and sold. When you buy a share, you're buying a small piece of a real business, its buildings, its products, its future profits. Imagine a small lemonade stand that wants to grow. The owner needs money to expand. Instead of going to a bank, he decides to sell shares to the public, an initial public offering, or IPO. Investors buy those shares, betting the business will grow. If it does, their shares become more valuable. If it fails, they lose their money. Companies use the money raised to expand, hire workers, build factories, create new products. Some even pay dividends, sharing profits directly with shareholders. In theory, everyone wins, but theory and reality rarely match in the stock market, because prices don't just reflect what a company is worth, they reflect what people believe it's worth also, and belief, as history shows us, is dangerously unstable. Chapter 2. The Rise of the Great Exchanges. The modern stock market has deep roots. In 1792, 24 stockbrokers gathered beneath a buttonwood tree on Wall Street in New York City. They signed a simple agreement that would become the foundation of the New York Stock Exchange. For nearly 2 centuries, the NYSE dominated, home to America's industrial giants: IBM, General Electric, US Steel. Then, in 1971, something revolutionary happened. NASDAQ was born, the world's first fully electronic stock exchange. No trading floor, no shouting brokers, just computers executing trades at lightning speed. It became the natural home for technology companies. To measure the overall health of these markets, indexes were created. The Dow Jones Industrial Average tracks 30 major American companies. The S&P 500 tracks 500 large corporations across all industries. Around the world, similar indexes emerged: DAX in Germany, FTSE in London, Nikkei in Tokyo. These numbers, rising and falling every day, became the pulse of global capitalism. When they climbed, we called it prosperity. When they crashed, we called it catastrophe. Chapter 3. Why markets crash. For as long as stock markets have existed, they have crashed. Not occasionally, regularly. Historians have identified 3 main causes. The bursting of speculative bubbles. Sometimes, excitement about new technology or new opportunity drives prices to absurd heights. People stop asking, what is this actually worth, and start asking, how high can it go? The most famous example is the dot-com bubble of the late 1990s. The internet was new, revolutionary, world-changing. Investors poured money into any company with .com in its name. The Nasdaq soared 800% in just 5 years. Companies with zero revenue were valued in the billions. Pets.com, which sold dog food online at a loss, spent millions on a Super Bowl commercial. Then, reality arrived. People asked a simple question: when do these companies actually make money? And then the bubble burst. Between 2000 and 2002, the Nasdaq fell 80%. $5 trillion in wealth vanished into thin air. Economic stress and policy mistakes. Sometimes, crashes come from deeper structural problems. Inflation spiralling out of control, aggressive interest rate hikes that choke economic growth, recessions that destroy consumer confidence. When the economic foundation cracks, markets tumble. Black swan events. And sometimes, crashes come from nowhere. A war breaks out, a pandemic sweeps the globe, a massive fraud is exposed. In March 2020, as COVID-19 spread worldwide, stock markets fell 30% in just a few weeks. Fear moved faster than the virus itself. Chapter 4: The Great Crashes of History. Going through history's most devastating market collapses, we begin with the very first one ever recorded. In 1637, a market crash known as the Tulip Mania happened. Our story begins in the Netherlands, 1637. Tulips had recently arrived from Turkey, and Dutch merchants became obsessed with them. A rare tulip bulb could sell for more than a luxury home. Futures markets developed, people trading bulbs that hadn't even bloomed yet. Then, one February morning, buyers simply stopped showing up at auctions. Confidence evaporated overnight. Prices collapsed. Fortunes built on flowers disappeared like morning mist. This was humanity's first recorded speculative bubble. It would not be the last. 1929. The Great Depression. After World War I, the US became a global superpower, but faced domestic challenges transitioning from wartime to peacetime economy. The 1920s saw increased consumer spending through easy credit, leading to widespread debt, particularly among struggling farmers and rural workers. The Great Depression was triggered by multiple factors. The October 1929 stock market crash that devastated banks and investors, production surpluses in industries like automobiles, the environmental disaster of the Dust Bowl, and increased tariffs that reduced international trade. These caused financial instability, high unemployment, and inflation. The crisis had far-reaching impacts. Millions lost jobs, families fell into poverty, and mental health suffered. Organised crime flourished as people turned to illegal activities. European countries dependent on US funding for post-war reconstruction were also affected. President Hoover's limited government approach proved inadequate, leading to his defeat by Franklin D. Roosevelt in 1932. However, the Depression brought positive changes. The government took a more active economic role, establishing Social Security and unemployment insurance. New financial regulations like the Glass-Steagall Act of 1933 and Fair Labor Standards Act of 1938 were implemented. Labor unions grew stronger, securing better wages and working conditions. The Depression ended through several factors: increased government infrastructure spending, technological advancements like the assembly line, improved banking regulations through the FDIC and SEC, FDR's New Deal programs, and ultimately US entry into World War II, which mobilized millions of workers. 1987. Black Monday. Black Monday, also known as Black Tuesday in some parts of the world due to time zone differences.
Down a record 508.32 points. Panicked traders worked through lunch hours in a desperate but losing attempt to keep up with tickers that rolled up an all-time high volume. CBS News business correspondent Ray Brady looks at this devastating day.
Was a global, severe, and largely unexpected stock market crash on Monday, October 19th, 1987. Worldwide losses were estimated at $1.71 trillion US. The severity sparked fears of extended economic instability or a reprise of the Great Depression. The Dow Jones fell 22.6% in a single day, the largest one-day percentage drop in history. Traders on the floor of the New York Stock Exchange stood frozen, watching fortunes evaporate in real time. Some wept openly. Yet within 2 years, the market had fully recovered. 2008, the financial crisis. The 2008 financial crisis was a severe global economic downturn triggered by the collapse of the US housing bubble and the subsequent subprime mortgage crisis. Fueled by low interest rates, lax lending, and risky derivatives, CDOs, the crisis led to massive bank failures, most notably Lehman Brothers in September 2008. This sparked a global recession, bank bailouts, TARP, and the deepest economic downturn since the Great Depression. The housing market had been booming for years. Banks were lending money to anyone with a pulse. These risky mortgages were bundled together and sold as safe investments to pension funds, insurance companies, and foreign governments. Then, homeowners started defaulting. The house of cards collapsed. Bear Stearns vanished. AIG required a massive government bailout. Retirement accounts lost 40% of their value in months. Millions lost their homes. The global financial system nearly stopped functioning. The human cost. Beyond the numbers, these crashes destroyed lives. Jobs disappeared, businesses closed, pensions evaporated. Families that had saved responsibly for decades watched their security vanish overnight. The psychological scars lasted generations. But here's what most people don't realise. While millions lost everything, a small number of people became extraordinarily wealthy. Chapter 5. The Men Who Got Rich from Disaster. Let me tell you about 3 men who turned catastrophe into fortune. J. Paul Getty, 1929. J. Paul Getty was an established, wealthy oilman who astutely navigated the stock market crash to build massive cash reserves. Between 1923 and 1929, he grew his fortune from $39,000 to over $6 million. Following the 1929 crash, he used these reserves to heavily invest in Tidewater oil stock. He understood something others didn't. The companies were still there, still pumping oil, still valuable, just the price had collapsed. He waited patiently as the economy recovered. By the time he died, he was one of the richest men in the world. Ray Dalio, 1987. Ray Dalio, founder of the investment firm Bridgewater Associates, famously navigated the 1987 Black Monday stock market crash by correctly anticipating a major market downturn, allowing him to prosper while many others suffered. Having previously gone broke in the early 1980s by inaccurately predicting a depression, Dalio adopted a radical open-mindedness that helped him read the signs of 1987, including tightening monetary policy and high valuations, leading to his successful bearish positioning. Today, Bridgewater manages over $150 billion. Michael Burry, 2008. In 2005, a quiet doctor-turned-investor named Michael Burry started reading mortgage documents. What he found shocked him. Banks were lending hundreds of thousands of dollars to people with no income, no jobs, no assets. These loans were being packaged as safe investments. Burry knew it would collapse, so he did something radical. He bet against the entire housing market. When the crash came, he made billions. So did a handful of others. John Paulson, who made $15 billion personally, and Jamie Dimon, whose bank, JP Morgan, emerged stronger by absorbing failing competitors. The pattern. These men weren't lucky. They weren't insiders. They simply understood something fundamental about crashes. Wealth doesn't disappear during a crash. It transfers. Chapter 6. How you can benefit. So what can we learn from history? The mistakes that guarantee failure. Panic selling. When markets fall, fear overwhelms logic. People sell at the worst possible moment, locking in losses, trying to time the bottom. Nobody can predict the exact low point. Waiting for it means missing the recovery. Chasing garbage. Just because a stock is cheap doesn't mean it's valuable. Some companies deserve to fail. Poor diversification. Putting all your eggs in one basket is dangerous. FOMO buying. Buying stocks because everyone else is, especially near market peaks, is a recipe for disaster. The strategies that work. Dollar cost averaging. Invest a fixed amount regularly, whether markets are up or down. This averages your costs and removes emotion. Focus on quality. Strong companies with real profits survive and thrive after crashes. Diversify. Spread investments across different sectors, bonds, and index funds. Do your research. Understand what you own. Read, study, learn. Stay patient. The market rewards those who can wait years, not months. Professional strategy. Short selling. Betting against overvalued assets. Extremely risky, not for amateurs. Chapter 7. Looking to the future. Today we're watching a new phenomenon unfold. Artificial intelligence. Companies with minimal revenue but grand promises are attracting billions in investment. The excitement is reminiscent of the dot-com era. Will AI transform the world? Probably. Does that justify current valuations? History suggests caution. The internet did change everything, but that didn't prevent the dot-com crash from destroying trillions in wealth. Transformation and proper valuation are two different things. If expectations outpace reality, as they have so many times before, another crash will come. Conclusion: the lesson of history. Let me leave you with this. Crashes are not anomalies. They're not mistakes that better regulation can prevent. They are built into the very nature of markets and of human psychology. As long as humans can be greedy, fearful, and irrational in groups, crashes will happen. But history teaches us something else. Markets always recover. Sometimes it takes years, sometimes decades, but they recover. And when they do, those who stayed calm, who kept investing, who understood the cycle, they emerge wealthier. The stock market is not a casino. It's a mirror. It reflects human nature, our optimism and our folly, our rationality and our madness, our patience and our panic. The question isn't whether crashes will happen. They will. The question is, when the next one comes, will you understand what's really happening? Will you see disaster or opportunity? Will you panic or prepare? History has given us the answer. The choice is yours.